right, welcome back. Welcome back to another session with MMC University, where we're here to help you pass your SIE exam. So again, my name is Claudia, and I will be doing a brief session with you guys for today. I hope that you are excited about learning some more about what investing is with stocks and warrants today. And so just get ready, get your notebooks and pen ready. We're about to get started. We're going to dive right into it. All right. So let me make sure that my clicker is working. Let's do it this way. Okay, so we're going to be talking about stocks rights, what's also called preemptive rights. And so what those are, stock rights are instruments that are issued by companies to provide current shareholders with the opportunity to preserve or keep their fractional ownership in a corporation. Right, that's a mouthful, so I'm going to explain to you a little bit what that means. It allows investors to buy newly issued shares before the company offers them to the general public. And so you want to imagine a situation where the company has already had its initial public offering, and now you are one of the investors who owns a certain amount, a percentage of stocks from that company. But the company is at a point where they want to raise more money. So what they want to do is they want to go ahead and issue out new stocks, and they're going to offer them to the public. But what happens when the company does that is now there's more shares in the market. And so if you had owned 20% shares, your shares are going to get diluted and your percentage ownership is going to get lower. It's going to decrease because there's just more shares in the market now. So imagine if there was, a million shares in the market and you own 20%. So you had 200,000 shares, and now there's another 100,000 shares on the market. Your 200,000 shares is no longer 20%, maybe it's 19 or 18% ownership. So in order to make up for that, what companies do is they do a stock rights offering where they allow the existing stockholders to be able to buy those shares at a discounted price. And so the market value of the shares, let's say out in the general public, maybe they're selling at $50 a share. So when they do the stock offering, the existing shareholders might get to buy it at $48 a share or $45 a share. But they're also issued what we call stock rights in proportion to how much shares that they own. So for example, this stockholder who has that 20% ownership, let's say that they have 200,000 stocks with the company, they would be issued 200,000 stock rights, which they could exercise to see if they could buy those new shares at that discounted price so that they can keep the same amount of ownership, the same percentage of ownership, fractional ownership in the corporation, so their shares don't get diluted. So the shareholder, once they're given that option, they can exercise their rights to buy the stock. Normally they do that by taking the rights and the discounted price, and they send it to the stock rights agent, and then they're able to exercise those rights. Or they can choose to sell their rights and profit from the market value. Because remember, there's the price the company is going to sell these new shares to the general public, but then there's this discounted price that they're selling it to the existing shareholders. So instead of, maybe they don't want to buy those extra shares. So instead of doing that, they could sell it to someone else out there in the secondary market who's willing to buy those shares and profit from that as well. The other option they have is that they could let their rights expire and lose their value. But let me tell you, that's not likely to happen when they have those other two options, when they can exercise those rights to keep their percentage ownership the same, or to actually make a profit from them in the secondary market. And if they did let those rights expire and they lost their value, that would have caused the proportionate ownership to be lower, not something that investors are looking for. All right, so I hope that you guys are good with that. We're going to differentiate a little bit between stock rights and warrants. So warrants are long-term instruments, okay? And that's the opposite of the stock rights, because the stock rights are short-term instruments. Normally those have a subscription period. of 30 to 45 days. But the warrants, they're long-term instruments that also allow the shareholders to purchase additional shares of stock at a discounted price. But they're typically issued with an exercise price that is going to be above the current market price, and they're expected to be exercised sometime in the future. That is why that they are longer term instruments. So normally there's a waiting period of perhaps 6 months to a year that's assigned to warrants, which gives the stock enough time so they can raise enough money so that the exercise price can become higher, right, than whatever the current market price is. Warrants are usually offered in conjunction with fixed income securities. So, for example, let's say that there's a corporation, they issue a bond. You, as the investor, buy the bond. They might sell you the bond and bundle in there, let's say, 10 warrants, which allows you to buy, let's say, 10 shares of stock in the future when you choose to exercise it. So it is usually as a financial enticement to purchase a bond or a preferred stock. So I want you to imagine the scenario of a warrant a little bit. So again, you go to buy this bond or this preferred stock, and they want to make it look more attractive. So they attach these warrants to it as part of the bundle, which of course you want to buy that. And they will have that. Let's say, for example, that bond or that preferred stock is selling at $50 a share right now. The exercise price on that warrant is going to be, let's say, $75, which is higher than the current market value. But normally, let's say that you hold this warrant for anywhere from 6 months to 15 years. You could hold, they're long-term instruments. And the investor is hoping within that period of time, within that 5, 10, 15-year period of time, or even that 6-month period of time, that the price of that stock is going to be higher than that. Let's say the exercise price, if the current price is $50, the exercise price, let's say $75, the investor is hoping that by the time they exercise it, maybe the stock will be selling at maybe, let's say, $85 or $90 or even $100 per stock. And so that is the advantage of having a warrant attached to a bond or preferred stock. All right. And again, it makes the security more attractive. We talked about that. So now let's switch gears a little bit. We're going to look at Rule 144 and look at how it relates to restricted stocks and control stocks. So Rule 144, what is it? Okay, it applies to shares that are sold through a non-standard offering and are subject to resale restrictions and to sales by persons who are classified as a control person, or what we call an insider person of the issuer. All right, so what do they mean by a non-standard offering? Maybe those shares were purchased through a private placement and they didn't go to an initial IPO or a regular stock offering. Okay, so it was non-standard, and whenever it's non-standard, the government creates certain rules that apply. So what we call restrictions that governs when and how much of those stocks can be resold in the manner that they can be resold. All right. So Rule 144 applies to, again, what we talked about, restricted stocks. So a restricted stock is a stock that cannot be sold until the issuer removes the restriction. Normally, when they issue these restricted stocks, all right, on the certificate itself, there will be a legend or a symbol there that warns about a holding period. And normally they require that the securities must be held for a period of 6 months, okay? And they must be fully paid and held for a period of 6 months before they can actually resell them again, okay? So restricted securities are acquired through, again, some means other than a registered public offering, such as a private placement. And Rule 144 states that the holding period, like I said, for restricted stocks is 6 months before the investor may begin reselling those shares, and the issuer must remove that restricted stock symbol on that certificate before they can be resold again. All right, so along with restricted stocks, we also have Rule 44 applying to control stocks. So now, what is a control stock? Those are stocks that are owned by the directors, the officers, or persons who control 10% or more of the company, okay, or 10% or more of the issuer's voting stocks. And so let's take example of this individual who owns 8% of ABC stock. That's not a control person. They only own 8%. They haven't reached that 10% criteria. But let's say the spouse of that person also owns 3% of the ABC stock as well. Now they're going to add those two together. So now they're going to have an 11%, okay, ownership combined. And so that's going to be over that 10% or more limit. Now Rule 144 applies to it. And before they can sell any of those securities, they're going to have to complete Form 144. Okay. And that form is what's going to determine the number of shares that they can sell over that 90-day period of time. And then there's also limitations as to how much of those shares they can sold. Normally the greater of, let's say, 1% of the outstanding shares of the company, or whatever the average weekly trading volume was for the most recent 4 weeks. Okay, so those are control stocks. I hope that you guys understand the difference between the stock rights and the warrants, and then what Rule 144 is, what it applies to when it comes to restricted stocks and control stocks. All right, guys. So again, just really blessed to be here helping you guys with this. If there's anything that you got in this that's really helpful to you guys, go ahead and in the comment below, let us know. And if there's a specific topic that you guys would like us to tackle, we'd be more than happy to try to help with that. And don't forget to